Again, a new case in the chapter marginal costing and the same point key factor analysis. This time the data available is there are three products A, B and C manufactured by using the same raw material and applying the same labor force and the production capacity installed in the factory. The information given is budgeted production and sales in units 1800, 3000, 1200. Selling price rupees 60, 55 and 50 per unit. Requirements per unit. Direct material in kilograms 5, 3 and 4 respectively. Direct labor hours 4, 3 and 2. Variable overheads rupees per unit 7, 13, 8. Fixed overheads per unit 10, 10, 10. That is confusing. The per unit amount is constant, but fixed cost is always considered as a total amount. How to arrive at the total amount? This per unit amount should be manufactured by the relevant number of units. What do we mean by relevant number of units? If there is no other information in case of key factor analysis problem, then always multiply the per unit fixed cost with the demand or maximum sales potential. But wherever any information like budgeted sales etc. is available, then we should multiply the per unit fixed cost with this budgeted number of units and not the sales potential. This is actually limitation of style of asking the question. But the logic behind this is this amount is actually derived from the total amount of fixed cost, which is a single amount for the whole factory. First, the total fixed cost is distributed among three products, and then it is divided by the relevant number of units of the product to arrive at the per unit fixed cost. Here we believe that this per unit fixed cost has been calculated by dividing the total fixed cost per product by the budgeted number of units and not the demand or maximum sales potential. Then cost of direct material per kg rupees 4. Multiplication of kilograms and this cost will give us the direct material cost. Similarly, labor hour rate per hour. Labor rate per hour. So multiplication of hours and this rate will give us the direct labor cost. Since same raw material and same labor are used for all the three products, see the rates are same. Maximum possible units of sales, that is demand 4000, 5000 and 1500 units, that is to be considered at the time of determination of optimal or the most profitable product mix only. Yes, only 18,600 direct labor hours are available. This phrase suggests that direct labor is the key factor. But what to do? If these number of hours are not sufficient, then only direct labor is treated as key factor. You can first multiply the budgeted units by the number of hours and compare it with 18,600. You will find that there is shortage of direct labor hours, and that is the proof or statistical proof that direct labor hours is the key factor. But to make all other calculations, first we have to find out the contribution per unit. And what is contribution per unit? It is selling price minus variable cost. Selling price is given to be 60, 55 and 50 respectively. And there are 3-4 items which can be included in the variable cost. First is direct material cost. Direct material cost, that is kilograms into rate. In case of A, kilograms 5, rate 4, 20. In case of B, it is 3 and 4, 12. In case of C, it is 4 and 4, 16. Plus direct labor cost, that will be hours into rate. Hours 4 and rate is 2, 8 rupees. Hours 3 and rate is 2, 6 rupees. Hours 2 and rate is 2, 4 rupees. And another item is variable overheads. variable overheads. And they are directly available 7, 13 and 8. There is no other item to be included in variable cost. So the summation is 20 plus 8, 28 plus 7, 35, 12 plus 6, 18 plus 13, 31 and 16 plus 4, 20 plus 8, 28. These three amounts are variable cost or variable cost, whatever you call it, according to your pronunciation. Now there is contribution. Selling price minus variable cost. 60 minus 35, it is 25 per unit contribution from product A. 55 minus 31, 24 and 50 minus 28, 22. This is contribution per unit. Now, if labor or direct labor hours being key factor, the profitability will be contribution per hour, that is nothing, contribution per unit divided by hours per unit. In case of A, contribution per unit comes to 25 and hours 4. So 25 by 4, it comes to 6.25 rupees. That means if we use one labor hour for product A, average contribution of 6 rupees 25 paise is generated. In case of B, contribution is 24 and hours 3. So it will be 24 by 3, that is rupees 8. That means if we use one direct labor hour for B, average contribution of rupees 8 is generated. And in case of C, contribution 22 and hours 2 only, rupees 11. That means if we use one direct labor hour for production and sales of C, average contribution of rupees 11 is generated. So C is more profitable when direct labor hours being the key factor. So the ranking will be 1, C, 2, B and 3, A. So we can say that C is the most profitable product when the direct labor is key factor. In the next lecture, we are going to determine the optimal or the most profitable sales mix and profit from that sales mix. Thank you very much.